Welcome back, everybody. Today we're talking about setting up your business and how to access finance. And as you know, getting access to finance proves to be part of the difficult part of setting up your business. So today I'd like to welcome Stuart Yule and Sandra McLean from DSL Business Finance. They're going to be discussing and giving you opportunities and exploring various ways of gaining access to starting a business. So over to you two.
Thanks, Lynn. That's great. Hello, everyone. Great to be with you. My name's Stuart Yule, Executive Director at DSL Business Finance, a role I've been in for about the last 5 years. Before that, I had about 5 years where I was a volunteer board director with DSL. And prior to that, best part of 35 years in mainstream banking, covering all kinds of businesses, from startups and high growth startups and corporate, commercial, etc., right up to the top end corporates. I've also run my own business, a consultancy, for a number of years, and I really enjoy now working in this sector, something we're all passionate about, and hopefully you'll find this webinar of use.
Hi everyone, my name is Sandra McLean. I am a fund manager with DSL Business Finance. I've been at DSL now for nearly 25 years, so I've been there for quite a long time. And I've basically done almost every role in the organisation, starting from administration to debt recovery to assessing loan applications and loan sanctioning. So I've kind of been through the whole cycle. So yeah, it's really interesting to be here today, and hopefully you find this quite useful.
Great, thank you both.
Okay, so I suppose the first thing we need to do is think about how we get started. And there's various ways to start your business. But the most common thing that we see, and we see this all the time, is it's a term that crept in over the last number of years. It's originally from America, as a lot of these things are. We would call it just begging and borrowing from family and friends. But actually, bootstrapping seems to be the term that's now used. So it's a range of early stage methods that funds an early stage business. And most people, they scrape around, they use their credit cards and various other things, and they get to where they can with no debt or such like. You then move on to, I suppose, what you call later stage funding. It's a bit more formal and more dependent on external sources. So some examples of early stage bootstrapping. And you'll see the little pink piggy on the right, and that's the first source for most people. What have I got? What can I put into this? If I haven't got it just now, how can I get it? Well, actually, I've got a credit card. I'll use my credit card. I've got a house. I'll second mortgage my house. I'll get money from that. That's quite cheap. And what about family? What about friends? Mum and dad, brothers, sisters, whatever it may be. Where can I scrape together enough money to start to fulfill my dream of starting my own business? And it's not easy. It's not easy. We recognise that. Some people have the advantage of being able to find this kind of capital, and others simply don't, and it's just a non-starter and is not going to work. Lots of people have skills though, and even if you're maybe in a trade, for example, setting up your own consultancy doesn't do any harm. So consultancy income, that kind of thing, is also a good way to go about your early stage bootstrapping to get you on the first rung of the ladder, so to speak. And then you move on to the later stage. And it's more likely at that point that the business is growing. It needs a bit of external funding. You are wondering what the next step might be. You've some advisors. Hopefully you've some advisors. You're not trying to do all this yourself. It can be good to speak to peers, see how they've got through this early stage as well, and moved on to the later stage, and then they're into the more formal debt and applying for loans, etc., etc. So there's a whole list there on that page, and I'm certainly not going to speak to each one in the slide, but that gives you a flavour for the sort of things you can be thinking about as to, can they help my business? How can I access that finance? And we'll speak later about DSL and what DSL can do to help you access the finance. Because we don't do all of these. In fact, there's actually only one of these that we really do. But there are other providers out there that we've got very good relationships with that we can help you with to get an introduction to them. So you're then looking at other options. You've scraped around, you've begged and borrowed, you've drained the family silver, you've been to the pawn shop, or you hopefully not been to the pawn shop, but then you've moved on and you've got your potentially your other funding to get you on. But even crowdfunding is something that's become a lot more popular, probably in the last 10 years, and it's gathering momentum. It's got a varied press, I would say, and it's got a varied experience. And you'll only ever read about the really high profile, really successful ones where the businesses exceed their aim. And the thing with crowdfunding is, in general, you have to set a figure that you want to achieve. And then you go to a crowdfunding platform, and there are lots and lots of these out there. And basically, you Google crowdfunding and you'll find a whole lot of providers. And then you need to find out what it's going to cost you. But the main thing probably to understand about crowdfunding is what you're actually getting into and how it's possible to fund your business using crowdfunding. So in the first one, which is the simplest one, I suppose, is it's loan-based. So it's effectively peer-to-peer lending. So if you and I are interested in investing in a business, there'll be a prospectus. It might be will be online on one of the platforms. We've heard of the business. We might have, a vested interest in that sector, and we think to ourselves, I'll put some money into that. So lots of people put their money into the business using the crowdfunding platform, and then they get interest and a repayment of capital over time. And that's effectively what you're signing up to. And that's what the business is signing up to. It's signing up to give you a return for your investment. The second one is where it's investment based. Now, what you don't get there is you don't get interest per se, and you don't get return of capital over time. In other words, it's not a loan, it's an investment. So you effectively have a bond with the business, and the terms of the bond will depend on the platform and what sort of bonds they're offering. So it might be convertible bonds at 2.5% redeemable in 5 years. So and the business you're investing into know that in 5 years' time, you're getting that money that you've invested back with 2.5%. Now, I'm using a very fictitious number there, but that's the principle. So you're not seeing your money anytime soon when you invest in that way. There are two other methods, recognised methods of investing into a business using crowdfunding. The next one's actually donation-based. It might be something that people are passionate about. They simply want to donate because they like the goals, the aspirations, they like the purpose, maybe a social purpose, and it might be something that appeals to you. So effectively what you're saying is, here is my donation. And depending on the platform and depending on the business that you're investing into or donating to, there may be some taxation benefits to you as an investor, depending, as I say, on what sort of business that is. There are two types of investor methods that you can use. There's corporate interest tax relief and there's social investment tax relief, CITR and SITR. These businesses don't that often crowdfund, but they sometimes do. So if people are interested in those, that's another method that you might want to consider. And finally, the rewards-based one. And that is basically where folks invest into a business because they fancy the idea of getting a reward for investing. But once again, they don't get a return. Okay. Now, what quite a number of them do is, for example, if it's a business with a range of products, it may well be that for an investment of a certain sum of money, every month or every quarter, the business will send you some sort of product. It might be one of their products, or it might be something completely unrelated. It might be that if you put £1,000 in as an investor into the business, every quarter they'll send you a gift voucher for £20 for a meal for two, or whatever it may be. So these are the kind of things that are in consideration when you're going down the crowdfunding route. So if you wanted to crowdfund for your business, That's effectively the four options that you've got, the four methods that you can use. But again, you go to the platform and they'll advise you what's the best one for your business. And in general, in the early stages of a funding journey, you're pretty much in charge. You are the driver. It's your business. It's your ball. You've not given any equity away, and you are the decision maker or the decision makers. Because I appreciate maybe one as a sole trader is one thing. You enter a partnership, it's another. You come as a limited company, it's another. So there's various ways in which that happens. But basically, early on in the journey, you're in charge. But whatever method you choose, you need to consider advantages and disadvantages of them all. So whether it's the early stage, what methods you're going to use there, whether it's the later stages of bootstrapping, is your business high growth? If it is, then perhaps invoice discounting is something to consider. And it's a good thing for growing businesses. There's a bit of an adage that it can be expensive. Well, it's actually not that expensive. It's helping you to grow your business. And it's a very, very competitive market out there, and there's quite a number of providers. And the funding costs are interesting because, as we said early on in the journey, it is a beg and borrow, and you might find quite a lot of goodwill there. And we frequently see family money coming in to assist someone getting started, very often with no repayment terms, because we do have to have something in file that says what's the basis on which you're giving this, 10k or whatever it is to get this person started in business. And more often than not, with family money, it's a case of I'm not expecting any repayments in the first year or 2 years, and thereafter only as and when they can. In some situations, though, there is a very formal agreement, which is somebody who believes in the individual, believes in the business, wants to give them a chance, and they'll say, yeah, here's the money, but let's put something in place because it's quite a good discipline. And it's quite a good discipline for the business as well, because it means you have to factor that into what they're doing in terms of measuring their success. So it's about track record, and to access the funding, it's about the business plan. So I'm going to hand over to Sandra, because you're probably beginning to tire of my voice already. So here's another one for you.
Thanks, Stuart. So obviously, if you do decide to apply for some level of funding, one of the key documents that you need is a business plan. And within that business plan, we've detailed on the slide here some of the key areas that you need to look at and consider. So the first thing is the executive summary. Which basically, the executive summary is basically telling the lender who you are, what you do, and why you need the money. It's quite amazing, actually, sometimes when you get business plans in and you get to the second last page before you actually discover what the business does. So, you really need to kind of tell them that up front. The other key areas are the ownership and management of the business. So who owns the business? Who's your management team? What's their skills and experience? Normally we would ask for CVs of the key owners in the management team, if there is a management team, just to show that you have the skills and experience required to operate the business that you're running. What the process is, if you're a manufacturing company, how does that work? Do you have all the tools in place to do the job properly? Or are you looking for funding to buy the equipment that you need to operate the business more efficiently? That kind of sort of thing. Your market analysis. Who's your target market? How are you going to reach them? What's your marketing strategy? Who's your competitors? And how do you differ from your competitors? So what's going to make someone come and buy from you rather than buying from someone else? So that sort of thing is kind of like what we're talking about there. One of the other areas is environmental impacts, and what we're really talking about there is licenses. So even things like beauty therapists and tattoo artists, they need a license to be able to operate. So in DSL's case, the way that we would look at it is we could still consider an application from you, and we could approve a loan for you, but we wouldn't disperse the funds until we had evidence that you had already the necessary licenses in place. And the reason for that is if you don't have the license, you can't trade. And therefore, if you can't trade, you can't generate any income and you can't pay the loan back. So it's that's kind of the sort of things that we would be looking at there. So it could be all sorts of licenses, waste disposal. It really depends on your sector and the type of license that you may require in order to operate. I think even a window cleaner needs a local authority license now. So it can be as basic as that, or it can be something a bit more complicated. Like if you're in the care sector, you need approval from the Care Commission to operate as well. So the other key information that you need is your financial projections. So that would cover, your finances in terms of your cash flow, your profit and loss, and your balance sheet. So that would cover that. When you do your business plan, it can be really quite tricky. I think it's quite scary for quite a lot of people as well, because they've maybe never done it before. Most clients who come to us would either get some assistance through the local business gateway offices, because it's free service, and they'll help you put the narrative and the numbers together, or they'll get an accountant or someone else, some other consultant to help them do that. But you should know what's contained within those documents. You need to have ownership over it. Again, we get quite a lot of clients who would come to us and you'll say, how are you going to do X, Y, and Z? And they don't know, because they say, well, I didn't do the business plan, someone else done it for me. Or you ask about a figure in their financials and they don't understand it, because they don't really know. Someone else has done it for them. So you really need to understand your own business model in terms of how it's going to operate, and how the finances, the numbers that you've provided, and how they actually come together. So yeah, you would need to provide that information. You will be challenged on it. And in most cases, as I say, in terms of DSL, I can only speak for ourselves, but in terms of us, we tend to work with the clients, so I wouldn't worry too much about it. You get the opportunity, there will be the opportunity to sit down, chat it over, review it, and update it if it's, if required. So, but yeah, I do understand it can be quite a difficult experience for quite a lot of clients. As I touched on there, you need to provide a projected cash flow, profit and loss, and a balance sheet. So the cash flow should really reflect what's in your business plan in terms of the narrative. So I'm trying to think of an example. So if you're saying that you're going to, in your narrative, you're saying that your marketing strategy is going to be X, Y, and Z, then you need to cost for that in your figures. So, if some people, you might give us a cash flow and the financials for the marketing section are zero, but you've told us in your narrative that you're going to be doing all this different types of marketing strategies, so you need to account for the cost of that. If you're offering different types of products or services, ideally, depending on what you do, they should be split, and they should also include VAT if that's applicable to your particular business. Again, if you've got an accountant, they will help you and guide you with that in terms of, do you need to be VAT registered or not, or is it something that you can look at further down the line? And again, your expenses again should be include VAT as well, and it should add up. That sounds really, really silly and thingy, but again, sometimes we've seen it in the past where you get a cash flow in and it doesn't total, there's no totals on it, or it doesn't add up properly, or things like that. So yeah, if you just give it a kind of cast your eye over it once it's finished before you submit it to anyone, and just double check that it actually does add up. Again, the profit and loss, I think it's, again, an accountant would guide you on this, but your income should be, in terms of your profit and loss forecast, the income on that is net with that, so it doesn't include the VAT. Your raw materials, if there's that included, they should be deducted to show that, provide a gross profit figure. Again, if there's that included, that should be accounted for within the expenses. And the if you are applying for a loan, the interest is charged to the profit and loss, and the capital reductions are accounted for in the balance sheet. But that is a bit more complicated. And again, ideally, you would have an accountant to guide you if you were at the VAT stage of your business and doing that sort of stuff. So we would recommend that you do speak to an accountant if you're kind of slightly higher level, and they will also guide you in terms of the legal entity of your business. Should you be a sole trader or a partnership, or do they recommend that you become a limited company? So they will help you with that sort of detail. So in terms of your cash flow and your profit and loss, it's quite prudent to sometimes what will happen, to sensitise it in some way. What tends to happen is that you get one version of it, and it's clients come in and they're really excited because they want to, they've had this idea and they're all ready, guns blazing, ready to go, set up the business. And in some cases, they're very, very optimistic. And sometimes it's like you're the voice of doom, but that's not the intention behind it. The intention is just to kind of try and bring it down a level and say, well, okay, so this all sounds great, but what if you don't, what if your sales are, £2,000 a month you've projected, but what if you only do one? How's your number going to look at that point? Is it going to take you time to build up your sales? What if you have seasonality? Have you accounted for that? And how does your cash flow look at that point? Are you going to run out of cash? If you are going to run out of cash, do you have a backup position there? Like, do you have an overdraft to cover any kind of seasonality, or if the sales dip for whatever reason? So in some ways, you're maybe looking at it best case scenario, and you're probably looking at it worst case scenario, and it's maybe about trying to meet in the middle somewhere, and try and get something that we think is, and that you believe as well is reasonable and achievable. Because at the end of the day, we can only try and guide you. It's your business plan, it's your financials, you own it. All we can do is try and give you some tips with our experience and how we've looked at these in the past and we've seen things happening. So yeah. And I think we're back to Stuart now. Is that right, Stuart?
Yeah, we are indeed. So thanks very much for that, Sandra. A few good pointers there. We don't profess to be masters of P&L and the compilation of P&Ls and cash flows. Our role is more about the interpretation of them. But we've seen plenty over the years, and we certainly have. And the challenge that Sandra spoke about there is really important, because it's a use, and all our clients say it's a really useful exercise when they are challenged, because it does make them think and it does make them focused. But of course, the P&L doesn't pay the bills. It's actually the cash that pays the bills. I'm not suggesting you all have actually cash lying around the house, or you have a tin in the back garden that's full of money. But there needs to be something in the bank to pay the direct debits, the standing orders, the wages, all these things when they become due. So how can you preserve cash on your business journey from the start right through? So a few ideas in the next couple of slides. So when it comes to your assets and in terms of how you preserve your cash as you go through your business journey, because cash is king, and as we've said in the previous slide, and it's cash that pays the bills. So how do you preserve it? Well, do you really need to buy that new car or new van? Because it's really going to do the exact same thing as an older van or car. It's got 4 wheels, it's reliable, you've probably got a warranty, there's enough space to throw all the stuff in the back, do your deliveries, or ground the houses to repair whatever you're going to repair, whether it's boilers or pipes or whatever else. So don't be sucked into I must have a new car or I must have a new van, and it's all got to be properly liveried on day one, because it doesn't. This is about getting the business started and getting going. So think about how you can cut out unnecessary expense and just have the necessary expense. So don't always buy things. Borrow them if you can. If you have people who are already in business, they're not direct competitors, they want to give you a bit of a leg up, they'll have some equipment that maybe don't need or don't use all the time. Maybe you could use them for a short time. Equally, do you really need to buy premises? Probably not. And in terms of cash preservation, if you're rather than buying a small unit for £30,000 or £40,000 and using up hard-earned cash, enter into a lease with a reasonable payback period and retain most of that bounty that you've got, because you're probably going to need it at some stage of the business journey. And then there's a working capital cycle, as we call it, which comprises three things. There's really three things that influence how much cash you'll ever have in your business and available resources effectively. And that's how much is you got this lying there at any one time doing nothing. And that's what stock is. Stock is something that sits there and does nothing until it's sold. So that's the first part of the working capital cycle. And the second two are your debtors, so people that owe you money, and creditors, people that you owe money to. So how do we try and maximise the benefit we can get from these necessary aspects of the business? Every business has to have stock. Doesn't need to actually sit in the business. A lot of online businesses now are really, really efficient at this. They have very little stock because the orders are delivered direct to the client, to the end user. So previously, where they had a warehouse full of stock, they now might have something the size of a garage full of stock because it goes direct from the supplier to the client. Reduce suppliers' lead time. That's one way you can do that. Don't bring it to you and then redistribute it. If you can get it direct to the client, speeds up the lead time, also speeds up the payment time. Think about how many variations of products or how many products you actually have to get yourself going. Quite often we see lots of people coming in the range. Sandra talked earlier on about the sales and the mix of the sales and showing the different sales lines in your cash flow. Sometimes these are quite long with 20 products. Do you really need 20 products to get yourself going? You probably need to figure out the ones that are going to sell well, sell them and generate cash. So minimize the product variations because that minimizes what you need to bring in, but it also minimizes production. Learn what sells and sell those. So concentrate on the things that have got good margin and sell them. And that's the quickest way to turn your stock into cash. Then you've got the debtors, the people that owe you money. Well, I can think back a number of years that businesses I've been involved with, and I can think of my banking days as well. And one of the big gripes we always had was businesses not invoicing promptly. There's always a lot of chat about not being paid promptly. But actually, if you don't invoice, you're not going to get paid. So in lots of businesses up and down the country, invoices are lying on desks or on PCs these days, and they're not actually sent out. So get into a routine, get into a habit and invoice promptly and make it really clear to your clients that your terms are 14 days or 30 days or whatever it may be. And that way, if it's not paid after 14 days, they're in breach and you can chase it. Think about offering discounts for early payment. This works really well in a lot of cases. And you might think it's not significant, but actually to some businesses, if there's a 10% discount for paying within 14 days, or no discount if it's 30 or more days, they'll go for the discount because they want to generate cash as well. And although they're paying you a bit more, in the longer term, it can work out well for them. And actually don't deal with people who don't pay you. Again, lots of situations I think of over the years where I was told that people were great clients, they were great customers, were really good customers. And then you say, well, when did they last pay you? Oh, we've got an agreement. They only pay us now and again when they can. I said, so you're quite happy funding their business. And actually, when the penny drops, that's what's actually happening there. People say, well, no, that's maybe not such a good idea after all. I really need to actually stop dealing with these people. So if they're not actually a payer, they're not a good client. So develop that mindset and embed that into your business from day one. And then, of course, this is who you pay. And this is where you kind of, this is gamekeeper and poacher scenario here, because I've just talked there about encouraging people to pay you. And now I'm encouraging you maybe not to pay others quite as quickly. And that doesn't seem right. And that's kind of counterintuitive. But it's the reverse of the same coin. Negotiate a discount for early settlement. So, you've got a right to ask for that as well. So if people are expecting you to pay them, then say, well, that's fine. I really, don't have the cash to pay in such and such a period, but we could do it. If there's a discount available, I can probably build it into my cash flow. Delay your supplier payments, but not too much. If you're dealing with established businesses who've been up and running for a long, long time, there's an interest and there's a benefit to them in you not going out of business too soon and you becoming a long-term client. So if they can look after you in the early stage, it's a mutual benefit. So delay supplier payments, but speak to them and let them understand your own cash flow position, that your new business, and reach any kind of agreement that might need to be reached, and then stick to it. And that's the key. Stick to the agreements that you make. Don't breach them, because if you breach them, they're probably not going to be made again. And then, of course, buy with others. The sports sector, the golf sector, for example, is quite a common one in this one, where you've got a disparate, bunch of golf professionals, for example, all working in different clubs up and down the country. So what they do is they form a buying group, and that gives them the benefit of discounts from the suppliers. Now, that can be done on a much smaller scale too. And in fact, in some of the local high streets in the smaller towns up and down Scotland, buying groups are popping up for similar products. So think about, if there's no buying group already established, think about establishing one if you're all buying from the same place anyway. And aim to improve payment terms. This, in general terms, across the creditor base. If you're a new business, you probably won't get a great deal of credit. It's probably going to be pro forma invoices and you have to pay up front. But once you've done that maybe 3 times, that's the time to lift the phone or drop an email or build a relationship with your supplier and say, that's us, we're now established, things are going quite well, can we get some payment terms, can we pay you in 30 days? And that's all perfectly reasonable, and it's in the normal way of business. And then there's the whole thing about your own expenses and the business expenses and how you control these. We've talked about some of it earlier on there. And particularly, I think, it's been really relevant in the last, really prevalent as well, in the past couple of years, certainly 18 months. Lots of people are home-based. There will be less expense for offices going forward. Now, that's not to say an office environment or a base or a manufacturing building or whatever it may be is not a requirement, because absolutely, in lots of cases, it is. And also people need interaction. But at the early stage of the business, if you don't need an office, maybe there's a saving to be made there. Students and interns, a great source of high quality knowledge at low cost. And I'm not advocating any form of slave labour here, that's completely wrong. But you can get highly qualified, highly motivated individuals who really want to put a marker down, build their own CV, build their own portfolio, and they'll come and work for you and actually be excited by coming and working for an early stage or growing business. So think about students and interns as another way to reduce your expense in the early stages. And barter, quid pro quo can still work. You do something for me, I'll do something for you. It's still out there and it still works. And it does actually, in some cases, it is what makes the world go round in some businesses. You can't do it for everybody, obviously, because then you wouldn't have any cash at all. But an element of that does no harm. And again, the point about delaying being full-time until that's affordable, sometimes the way to start a business is to gradually put it in place. So you might want to negotiate, if you're in full-time employment just now, negotiate reduced hours with your business. They might be quite happy to agree that, explain to them what it is you're looking to do. And it's much easier if you take them with you on that journey, and they might be quite happy to go on that journey, and then gradually extract yourself from the business and go full-time. And if that's done in a cooperative and collegiate way, it can work well. So a few ideas there as to how to preserve cash. I'll now leave Sandra to tell you a bit more about DSL and who we are and what we do.
Thanks, Stuart. Yeah, so where does DSL fit into all this? DSL was established in 1993, really set up to create opportunities for new and existing businesses and social enterprises in Scotland. Obviously, when we first set up, we actually only covered Glasgow, but we do now cover the whole of Scotland, and to help create and maintain jobs and to strengthen the sustainability of communities through the subsector lending that we actually do. So yeah, that was our objectives and why we were created. DSL is a not-for-profit organisation, so we're a company limited by guarantee. We're also a member of the Community Development Finance Institution, so which is a network of organisations similar to DSL who operate throughout the UK. Some of them do business lending, some do just lend to third sector organisations, and some do personal lending. So we're part of that membership organisation, and we're also fully regulated by the Financial Conduct Authority, which allows us to lend to sole traders and partnerships up to £25,000. And we also have an accreditation for the Recovery Loan Scheme, which is the new scheme that's just been launched by the British Business Bank. So yeah, so we've that's our credentials basically in what we do. So what we do is we provide loans to both new and existing businesses, and as I said before, third sector organisations. And we do this through a variety of different funds. The main funds that we operate, so DSL is a delivery partner for the Startup Loans Company, which is a UK government scheme. And we'll go through all the different schemes later on, but the key ones are the Startup Loans Company, the Scottish Microfinance Fund, the Digital Development Loan Fund, and we've got a variety of our own funds as well, which includes RLS, which is the Recovery Loan Scheme that I just mentioned there. But as I say, we'll go into them in a wee bit more detail later on. Thank you.
So just a little bit of an overview now to give you an idea of DSL's activity in terms of lending to women in Scotland. There's always a lot of PR about this, and depending on what report you read, you tend to get a different answer. But in essence, in the last 5 years, our lending to women is about two-thirds, a third split in terms of numbers, and it's about 30-70 in terms of value. And I think that does bring out something that is quite widely accepted, is that in general, women tend to bring more to the party, for want of a better phrase. So if the average loan size is 21k, that probably means that the recipient of the loan has contributed a wee bit more than that in some form. So let's say it's a 30k loan, you might find that they managed to contribute 7.5, 8.5. Whereas if it's maybe not a woman that's getting the loan, there's maybe 5k coming in. Now, these are very abstract numbers, and you can read an awful lot into them, so we don't want to do too much of that, to be honest. But I think the main thing is that percentage there is it's comparable with the market. But what I would say is it's skewed, and it's skewed by the lending that we've done probably of the digital development loan, which is higher, tends to be a higher value loan, and it's also aimed at probably more established businesses. As a result, these businesses tend to be headed more predominantly by males and females. So if we stripped out the digital development loan contribution, if you like, to this table, actually lending to women is in DSL north of 40%. So in terms of the other funds that we run there, which Sandra mentioned, the Scottish Microfinance Fund, for example, our own loan funds, DSL is quite proud to say we're more than 40% lending to women. And that's really encouraging. We're delighted about that. But, bottom line is 246 women have received loans of just over £5 million in the last 5 years from DSL. So that's so we know the market, and we're very keen to learn to lend to that market. Next slide. And I just thought this might be of interest to you. This is obviously based on our 246. So unsurprisingly, it's the 70s, 80s and 90s born folks that to dominate that. But I would like to, the encouraging thing is that we're not prescriptive either. So strangely enough, we actually do have people who are considerably older and considerably younger. And actually DSL doesn't discriminate in that sense whatsoever, because we have been asked on occasions, what's the upper limit? I'm 65, can I get a loan? Answer, yes. If all else stacks up, then no reason why not. I'm only 18, can I get a loan? Well, yes, if all else stacks up. The difficulty for some of the younger clients is actually providing things like credit reports and things like that, because they might not actually have anything that's got anything meaningful on it. So we just have to try to do our best to work through that. But our loan officers and the loan officer team will work through people with that. So that's just a snapshot of the profile of the women borrowers in the DSL book. And this is a bit of a wheel, this one. But you can see very clearly there where the tendency is. But I think the bottom line as well is it's a broad church. That there are very few sectors that we can't lend into if it's legal and it's honest. Then we're able to do it. We don't do property development, we don't do property investment, and these are policy decisions of DSL. It's just not places we want to be. But in general, unlike a bank who will have, in lots of cases, red, amber and green traffic lights for various sectors, and what you'll find just now is that clearing banks in particular will be looking at this very closely in relation not just to women, but to all lending, very closely with regard to what's going on during a pandemic and where they're likely to take hits and what sectors are troubling them. And they will not have the appetite to lend into a number of sectors. We don't have that, although I'm not going to say for a second that some sectors, if they start to prove troublesome to us, will be a bit more cautious in them. So we have one or two that we've kind of got on the radar just now that we're just a wee bit careful with, or more careful than them all, but more careful. But we will still take risk that's reasonable, and we're very risk aware rather than risk averse. So there's no traffic lights saying you can't go into that sector. Okay. And this is actually the same thing. It's just that it's a bit more, your eyes kind of go to the bottom here and it tells you just the kind of the sectors we're in. So quite a lot there, I'm sure that you recognise. And the sort of businesses we lend to are also wide and varied, but unsurprisingly, most are limited companies, some partnerships, but lots of sole traders. So again, of the 246, 149 were limited companies and 79 were sole traders. And the rest is made up by a variety of different business types. And you'll see SKIOs and community interest companies and such like. So Sandra mentioned earlier on that we do lend to social enterprises as well. That's fine. And then the average funding package, and this is how it's made up. So fundamentally, women are able to attract funding other than just our own funding. So our average loan size is 21k, but quite often they'll come along with a contribution. Now that might be back, if you remember the bootstrapping slide, we class that as owner contribution. It might be family and friends money. It might be some, whatever it may be, that's in there. And then there's sometimes some grants from the public sector and smaller loans sometimes from the public sector as well. But fundamentally, it's going to be the owner coming along with some kind of contribution. Do you require a contribution to get a loan from DSL? No, you don't. That's the short answer. It's good if you've got it, but don't think if you don't have it that it precludes you from actually applying or potentially being granted a loan either. Okay. I think I was going to pass back to Sandra now to tell us all about what you mentioned earlier, the various loan funds that we have available.
Yeah, thanks, Stuart. Yeah, so the key loan fund that we operate for predominantly new businesses is, as I say, DSL is a delivery partner for the Startup Loans Company, which is a UK government initiative, and we cover Scotland on their behalf. The startup loan is a personal loan for business use, and you can apply for it up to 24 months of trading. So once you're over the 2-year mark, if you've been trading for more than 2 years, then you wouldn't be eligible for this scheme, but you can apply for it up to that point. As I said, it's a personal loan for business use, and you can borrow up to £25,000 through this particular loan scheme. The interest rate is fixed at 6%, and the loan term is between 1 and 5 years. So you can pay it back within a year, or the loan can be over a 5-year period. There's no arrangement fee for this particular loan, and there's no penalties for early settlement. So you can pay it back at any point in time, and you would only be charged interest up until the point where the loan was settled. All DSL loans are very flexible. So, if your monthly repayments are, for instance, irrelevant of which loan scheme it is, if your monthly repayments are, say, £200 a month, and you find you've got some extra some months, you can always pay a wee bit extra. And all that does would reduce the term of the loan and reduce the overall interest that you would pay back. So it is very flexible from that perspective. And as I say, you can pay it back in full early as well if you want, with no penalties. So that's the Startup Loan Company one. The other one is the Scottish Microfinance Fund, which we operate on behalf of Scottish Government. And again, it's the same terms and conditions as a startup loan scheme. The only difference is that this is a business loan rather than a personal loan. So again, that's loans up to £25,000 over a maximum term of 5 years with a fixed interest rate of 6%. Again, no arrangement fee and no penalties for early settlement. And that can be for a new or an existing business. There's no age limit there. So it could be that if you could be a new start business up to 2 years trading, but for whatever reason you might not be eligible for the Startup Loan Company loan. So we have got quite a good bit of flexibility where if you apply for that but you're not eligible, we can say, well, actually, you're not eligible for this, but we can signpost you, we can give you the same thing more or less, but just under a different banner. So yeah, that's the Scottish Microfinance Fund. The next one is the Digital Development Loan Fund, and again, that's on behalf of the Scottish Government and in partnership with Lanarkshire Enterprise Services. And the Digital Development Loan Fund is for businesses who are looking to digitise their business. And that can be a variety of different things. So one of the ones that pops into my head at the moment is an insurance company, and they were looking for some funding to develop an app so that when they were going out to customers, they could write up the quote through the app, which automatically sent it back to the base, and they could type it up there. It was all done there, rather than them writing out notes, going back, having to type it up. So basically, it was just an automatic process. I think we've had a butcher who was opening an online retail shop as well. So sometimes it's things that you might not think about. So there's loads of different ways that you can digitise your business. But that particular loan scheme is from £5,000 up to £100,000. The maximum loan term is 5 years and it is at 0%. I don't know anywhere else that does loans at 0%. That's the only one that I've ever came across. The other aspect of that is that if you're a limited company, unlike all our other loan schemes, if we're lending to a limited company, we will take a personal guarantee and a bonding floating charge, which is security over the assets of the business. But there is no personal guarantees and there is no bonding floating charge with this particular loan scheme, which again is almost unheard of, I think, in most cases. And that's available to SMEs. So that's up to, for businesses with employees up to 250 employees. And there's a link on there as well that you can get more information from. DSL, our own money that we lend, we do loans up to £75,000. And again, that can be for new and existing businesses. Maximum term on that is 5 years, with a fixed interest rate of 9.95% and an arrangement fee of 2%. So it is slightly more expensive than the other schemes that we operate. But that's because we have to borrow the money and then we on-lend it. So that's why it's slightly more expensive. You don't need security to apply for this loan. If if you have security available, we will take security with this particular loan. If you don't, we can administer it through the recovery loan scheme, which is from £25,000 up to £75,000. And basically what the recovery loan scheme is it's a scheme through the British Business Bank that is designed to help lenders lend to businesses without adequate security. That's really what the scheme is there for. And again, whatever loan that we have, there's no penalties for early settlement. You can pay extra whenever you want. This particular loan scheme, because it's not most of the other loan schemes that we operate are classed as public sector funding, a public sector loan schemes. This particular one is private sector again, because DSL borrowed the money from the bank and they unlend it. So you could use this as a match for any other loan schemes that you're applying to. So for instance, if you go to Business Loan Scotland, who do SME lending as well, normally you need to match what they're giving you. So if they're lending you 50,000, you have to match it with 50,000 of private money. So this particular pot of money is classed as private sector funding, so you can use that as a match, or for any local authority grant funding or other public sector grant funding. This would tend to come in where you have a much bigger funding package. So maybe you're looking to borrow or to raise something like 250,000. You have some funds of your own to put in. You maybe have some public sector funding, but there's still a gap there. And that tends to be where this pot of money would come into play. So I think that's the final loan scheme there. And then our contact details are all listed on the slide here. So DSL's website and telephone numbers for myself and Stuart, and email addresses. Thank you. Stuart, do you have anything you want to add to that slide there?
Only it'd be great if people would follow us, and we'll try and follow you back, because like everybody else, we're trying to increase our coverage and knowledge of what we do. So yeah, that's the final ask, the final appeal, the final call to action is please follow us, please find out where we are, and please get in touch with us. We're very happy to speak to you if there's any particular questions that come out of today. And I know there's a Q&A after this, and us or our colleagues will be happy to engage with you in that Q&A.
Great. Well, thank you both very much for taking the time out today to come online and discuss finance and opportunities, business plans, all the things, as you both said, sometimes scares people if they've never had to deal with it before, if they're coming out from a secure job, salary in the bank every month, to working out how they're going to start a business. As you see, all this information will be going into an online digital magazine that will be sent out to people that are looking to start up businesses, with all your contact details. If there's any issues, you can contact myself and I can redirect the emails to Stuart and Sandra. So thank you both very much. Appreciate today, and we'll look forward to seeing you on the live Q's and A's.
Thank you.
Thanks very much, Lynn.